Here we go. We started recording. Great. So welcome everyone. This is part of our new weekly schedule for Spaces. We have three events every week now on Spaces, starting with Sunday nights at 8 p.m. It's going to be a weekly wrap up, talk about everything that happened in the VIP community. Sunday nights at 8. And then Mondays at 4 p.m. we'll do trades of the week. Trades of the week, we'll be discussing the VIP trade ideas that were submitted the prior night in our VIP community, plus any additional, items of note from Monday. And then every Wednesday night, we're going to have some philosophical discussions regarding story trading. What's the title? Actually, what's the title? I forgot. What do we call these shows on Wednesday nights, Jared?
Discover the story.
Discover the story. There it is. Discover the story. So, discover the story. Tonight, we're starting with, are markets efficient? We're going to have a series of talks over the next 5 or 6 weeks to go through the implications of the conversation tonight. So, are markets efficient? Next week, I think we'll talk about the story behind the trade and couple other items. I forgot. We'll put out a schedule, but eventually we'll get into our 4 pillars, looking at markets holistically on fundamental, sentiment, catalysts, and technical. So we'll be having these philosophical conversations every week, and look forward to everyone's participation. So, regarding tonight's topic, are markets efficient? So why is it important to ask this question, right? The answer to this question impacts not only how you understand markets, but how you approach research, how you trade, how you invest. It's a fundamental question that is very, very consequential. And the answer to that question is also the inspiration behind the entire story trading brand, and fuels our mission and our vision over here at Story Trading. So it's also a topic that, at least in our early community, in our VIP community, has been a little bit of a controversial one. As we grow and as we, reach more people out there in the financial world, I suspect it won't be as controversial. But it is very controversial right now because it happens to be a good part of our community happen to be made up of people who are more fundamentalists, and they view the market through the lens of financial, modeling and how much intrinsic value of a company is. So there's a viewpoint out there that, the difference between the market value and the intrinsic value represents a market inefficiency. And, that's something that story trading does not hold or believe at all. So, let's just take a pause there, have a bunch of specific topics we'll go in, but I'll let, Jared chime in with his overall thoughts on this before we dive into some specific topics.
Sure, thanks. So, yeah, I think the question about are markets efficient, it really does you really do cut to the heart of it when you say questions about valuations. So I'm sure, like a lot of you out there, I've experimented with lots of different ways to try to do investing. And one of the ways that you can try to look for is like, what is the cheapest company by PE? What is the cheapest profitable company that doesn't have any weird debt issues or anything like that? Maybe that company will work out just like it worked out for Warren Buffett or Benjamin Graham or whatever. And I tried doing that for a while, and as you can imagine, it didn't turn out very well. So yeah, I'm definitely not going to be approaching this from a fundamentalist perspective. I'm not necessarily ideologically opposed to that perspective. It's just that I have experimented with a lot of different types of strategies, and I feel like that particular perspective hasn't served me well, so I don't really want to use it.
Yeah, I'm glad you brought that up because I also went through that learning, right? I went through a period of time where I was purely a fundamental investor. I went through a period of time where I tried pure technical investing, trading. I went through a period of time where I did purely catalyst trading. I'm not sure I did pure sentiment trading, But that's actually what led to the development and the creation of story trading, was looking at things more holistically with their four pillars of fundamental, sentiment, catalyst, and technicals. But I want to go back to the question of why it's important. Why does it impact things, whether you believe it or not? What's the implication of that, right? And I think that the implication of that is, when you hear that markets are inefficient, I'm hearing from the other side that, well, everyone else is stupid, right?
Yes,
The
that is
market's stupid,
ultimately what they think.
right? The market's stupid. I'm right, you know, and to me, that has a lot of negative implications to think that way. Because, first of all, in a way, it can make you lazy. It can make you have confirmation bias. It can dissuade you from looking at the bear thesis. It
Hmm.
can make you less curious about what's happened historically with the stock.
Hmm.
Um, and vice versa. If you believe markets are efficient, you're going to go out and find out what's the bear case. Why is it down this whole time? Why is it always undervalued? What are other people thinking, right?
Yes.
So there's a lot of fascinating implications to that. Um, so you know what? Let's actually maybe open it up. I see James here and Michael here. If you guys have some questions or you want to chime in with your perspective, uh, we definitely want to hear from you. Actually, here, let me give it to you. I got to do that here. So we'll give you the mic, James and Michael. We were talking in the VIP community earlier. And let's see if you get that while we wait for James and Michael. So I mean, I have a whole punch list here of things to talk about, but Jared, where do you think we should take this next?
Well, I would say, if I'm going to play devil's advocate for a moment, I would sort of ask this question like, if markets are efficient, how is it possible that some people, whether it's, a Warren Buffett or Benjamin Graham or anybody, why is it possible that somebody like that can find an undervalued company and make money? Wouldn't that seem to suggest that markets are inefficient?
So let's go back to that question. Let me actually define what I think is meant by efficiency and why I think the market is efficient. Um, the way I define efficiency is that all market participants are able to do what they want to do, based on the information that's available to them, right?
Okay.
So you have buyers and sellers, and you have, all these brokerage accounts with now zero commissions. You have the internet with free flow of information going on, right?
Hmm.
So I believe as long as people are able to do what they want to do, it represents the net market opinion of all market participants. And,
Hmm.
and to me that's the definition of efficiency. And I know some people have a slightly different definition of efficiency. So maybe let's talk about what is a definition of efficiency.
Yeah. Well, how would you define that word?
Yeah, well, I think market efficiency is basically that all market participants, are able to make the trades that they believe in based on the information that's available to them. And, generally speaking, I think the information that's available to them is pretty widely known, for the most part. I find very rare instances. I've been investing for, gosh, almost 30 years. And I hear from a lot of people like, oh, micro caps are less known. There's less,
Hmm.
people don't know the story. So there's a lot of inefficiency in micro caps. And I found that argument to be false based on my experience. And the evidence for that is a couple things. First of all, when we're looking at microcaps and people saying, oh, it's undervalued, right? Why is
Hmm.
it so undervalued? And people say, oh, people don't know information. Well, guess what? I spent a lot of time talking to people saying, hey, take a look at this stock. Take a look at this microcap stock. Here's the story. Here's all the information I know. The other people are telling me, hey, this stock should be worth only 10, but it's worth only 5. And guess what I hear? I hear all kinds of bear theses. I hear, well, they're too small, they're not going to be successful. Well, management's probably not very credible. You hear a million reasons why, with the same exact information, people are not interested in bidding the stock up to 10. They think it's good right where it is at $5, right?
Yeah.
And the other thing I've discovered with microcap stocks is, for the people who say the market is inefficient, and to me this is proof of efficiency, is that when you have a material event, some news that comes out, the market reflates that stock very quickly. Sometimes it gaps open 60%, 70%.
Sure.
You know, there's very little opportunity to get in. So that shows you how quickly new information is being priced in. So, you know, when it comes to microcaps in particular, and that's the area where I hear a lot of people saying there's inefficiency.
Mm-hmm.
Really, what's going on is that most of the rest of the market have a very strong bias against microcaps. They have bear theses about microcaps, that they're not going to be successful, that management won't be able to execute, that the larger companies are going to beat them to the ground, that earnings are not sustainable. And these are the actual things you're going to hear when you go and try to convince someone to buy, you know, a particular stock at 2 when you think it's worth 5. You'll hear all of this from other people,
Mm-hmm.
right? And you may discover things that you didn't even know. Like with SMSI, by digging around, I found out that there was something called customer concentration risk. No, product concentration risk it was. We knew about customer concentration risks when it was only Sprint, but why is the stock so cheap? I keep asking around. I couldn't find answers. I went to management. I said, well, how come institutions aren't buying? You tell me. You talk to institutions all the time. You know, I went directly to management, talked to them face to face. They said, well, you know, the institutions tell us that they're concerned about product concentration risk, that we only have one product. And that was, you know, in addition to customer concentration risk, which, you know, we kind of already knew about. So this is all the body of evidence that I've experienced over 20, 30 years of investing that show that even with microcaps, the market's efficient. I'll give you another example. When you have people say, oh, there's hardly anyone trading this stock, there's no volume, therefore it's underpriced, right? It's not necessarily true, because there's also the supply side, right? If all of the holders of the stock, right now, all of the holders of the stock know about the stock, otherwise they wouldn't be holding it, right? 100% of the shares are allocated to existing shareholders right now. They know something about that company. They set their ask prices at a certain level, right?
Mm-hmm.
So what you can have, I've seen situations where a stock has just a few thousand shares of volume, but the thing like goes up like 10% a day over a period of 2 weeks because there was some material information that came out, and there's hardly any sellers because they know about the company and they set their ask price high. So it doesn't even take knowledge. It doesn't even take marketing. You know, you don't have to tell the rest of the world about it, because if the existing customer base, the existing shareholder base knows the news, the price can be driven up simply by them setting the ask higher, right?
Yes.
So to me, these are all bodies of evidence which completely debunk the the thought process that microcaps, especially microcaps, have an inefficiency issue.
So
So
you think the market is efficient, but just in case some people are listening who are a little bit confused, you don't believe in the efficient market hypothesis, right?
So why don't you tell me what the efficient market hypothesis means to you, if you can summarize that for everyone?
Well, the efficient market hypothesis says that the market is efficient and that prices do generally reflect value. And what that means is then that it's pointless to try to pick your own stocks. It's basically just a waste of time, and you should just do an index fund. And I would
Right,
say
no.
the strongest case in favor of the efficient market hypothesis is if you look at hedge funds and mutual funds, generally speaking, they don't do on average a lot better than an index fund. And most
Right.
retail traders do not do better than an average, you know. And also something else which is really fascinating to me, if you just pick stocks at random, you usually can do about as well as a hedge fund manager.
Yeah, well, I don't know. Maybe there's some truth to that on a macro level, but when I think there's opportunities. I don't ascribe to that at all. I think just because the market's efficient doesn't mean you have to agree with what the market's saying, right?
So the
So
market can be both efficient and wrong. Can you give a good example of that?
I'm not even saying the market's wrong. I'm saying that the market's always right, the market's efficient, but I'm speculating about the future based on my own analysis and interpretation of how I think the current news that's sitting out there is going to impact the company in the future. So I have a certain world perspective, right?
Yes.
And I may feel personally, I may have an edge. I may be able to speculate that this $5 bill today is going to be worth $10 in 2 months, right? But that's me speculating that the efficient market will move towards that price because events will happen,
Yeah.
right?
I,
Earnings will be announced,
yeah.
management will execute, people will react, right? I'm speculating about the future. So that's where the investment opportunity is.
Yeah, I would agree with that. I'll give you an example of something that I did a few months ago. Um, there was a period earlier this year where a lot of names in the financial sector were doing well, and they're all kind of doing well as a group. And I thought to myself, is there a way to find a financial sector stock that's doing well that other people wouldn't be able to find? And one thing I found was that a lot of popular screeners like FinViz don't report the numbers for Canadian firms because typically they self-report in Canadian dollars. So if you just try to look for what companies have grown by more than 10%, Canadian financial firms just won't show up because the numbers aren't inputted into the database. So I went through it and manually added it up and found a Canadian asset manager that was growing really fast, but the share price hadn't quite grown. Like it was growing, but it wasn't growing as fast as some other companies. And I thought that, I think as more people become aware of this in the future, doing the same process that I did, manually adding it up, it will go up. And that is what happened.
Yep, yep. That's good. That's
So
a good answer. James, go ahead, James. I see you.
Yeah, I want to make an observation. So when you say that the market is always right, to me it kind of seems like a meaningless tautology on par with it is what it is. And I don't, if the market's always right, then there's no such thing as right or wrong because there has to be a dichotomy there. But I mean, it kind of flies in the face of how to say, like if a company is trading for less than its book value, well, if someone were to take it over, like Warren Buffett did at one time, and then sell it off in bits and pieces, then the market would have definitely have been wrong because he profited from buying up all the shares and just selling the company.
Well, let me talk about what we mean when we say the market is always right. Meaning, an asset is only worth what you can sell it for, right?
Right.
So you may say, hey, SMSI is really worth $20, but if it perpetually trades at $10, well, that's all that matters, because that's all you're going to get paid for it is $10. And if Tesla is worth 500, but it's always trading at 1,200, well then that's what you're going to get for it, $1,200. So that's what I mean by the market's always right.
if
You know,
Warren
it,
Buffett
it's
can take over a company and sell it off in bits and pieces for more than what he paid for it, Warren Buffett didn't discover that value. He created that value.
nicely said there. Yeah.
What do you mean by created the value? Because the value was there before he bought it. It's just that others didn't recognize the value.
I wouldn't necessarily think about it that way. If Warren Buffett wasn't there, I don't think the value would have existed. He was the one that thought, I can sell this company off in these different pieces and make this money. And without that vision, the value just didn't exist.
Well, the value of itself was nullified whenever he basically destroyed the company. And that kind of excluded the market's opinion of what it was worth in favor of actual cash that he got from selling the company. No?
I mean, I guess I think something you brought up a related question, which maybe is a good segue, because we were speaking to you earlier, and you said, is the market rational, which is a slightly different question, right? And do you think the market is rational or not, James?
I do not think. I think the market can be rational. And I think that the periods of irrationality is where there's the greatest potential to make the most money.
Okay.
So that's a good segue. I'm going to say something that may sound crazy to some people, but why is there an assumption that a stock should trade based on its financial value? Period. Right? Why would you say, hey, the only reason why someone would want to buy SMSI is because they will print X number of EPS a year and a half from now or 2 years from now? By the way, it's not necessarily they will. You're speculating that they will, first of all. So there's already a market weighing going on there about speculation, right? But, why do you think, and people buy assets for all sorts of different reasons, and now it's clear that more than any time in history, whether it's art or NFTs or crypto, or even when you buy a house, any kind of asset you buy, there's different reasons for it, and in the stock market too. There's different types of investors. There may be investors who are more dividend oriented that want to generate income. And then there are investors who are more aspirational. They want to be they want to be an owner in a company that may change the world one day. There may be sentimental reasons for owning a stock because they just want to support it for, whatever moral reasons they have, or the friends and family may work there, so they may feel good to own the stock. A great example is DWAC, right? Where, DWAC, I believe there's a lot of sentimental value built into that stock, but just because it's sentimental doesn't mean it's inefficient. Why are we writing off non-financial reasons for people to own a stock? And I think that's maybe at the core of this discussion is, the other side of the argument that's saying, hey, the market is inefficient. They're only looking at the financial side of it. There's a lot of reasons why someone might want to buy, own, or sell a stock. So I ask you, James, right?
Mm-hmm.
Why do you not give any credence to those people who say, I may want to own a stock for a different reason other than what EPS they may have in 3 or 4 years?
Oh, I do. I think it's important to be clear that I do place value on sentiment, but the problem with sentiment, unlike fundamentals, is that it can't stand on its own. So what I mean by that is that if I were to just look at a company's financials and make a decision to invest in them based solely on the financials, then I have an objective metric outside of my own personal opinion of the stock to guide me in deciding whether or not to purchase it. In truth, my opinion is formed by something esoteric or outside of myself. But with sentiment, that's not quite the case. It has to come from an internal belief. And if the value of something is based on an internal belief rather than some sort of objective standard, then it becomes arbitrary in a sense. And if something's arbitrary, like for example, my old favorite T-shirt, I should probably get rid of it because it's old and nasty, but I don't want to because it has sentimental value to me. But it doesn't necessarily make it a rational decision on my part. Where I think that sentiment is most powerful is where it's used in conjunction with fundamentals, because then it drives pricing, or rather helps drive pricing along a given path. But to answer your question before about why a ticker should be based purely on the financials, and I wouldn't necessarily agree with that, but it relates to the fundamental nature of what they're purchasing, which is a security. And the security is a business interest, and it entitles them to ownership of the business, which value is measured by finances.
And that's, that very last point I would disagree with. I don't think the value is necessarily measured by finance. And that's, when we talk about efficient or inefficient markets, we're talking about a market where you're selling a security to another human being. You're not selling a security to a spreadsheet. So, this theory that if all the information was out there, then, for example, SMSI would necessarily be $20. Well, that's totally ignoring the other half of the formula there, that there's information, but how does how do all of these people interpret that information?
Yeah,
How do they analyze that information? What's important to them? They may
I,
not
yeah.
care that SMSI is going to print $2 in $2 in a couple years. Or you go ahead, Jared.
I was gonna say, I think maybe an easier way to distinguish this is, I would say, yeah, like markets are rational, markets are efficient. I think people can be irrational. People can make irrational decisions, or decisions. I would say wouldn't want to place a value judgment on someone else's decision. I would say someone else may make a decision that appears irrational to me because I can't be a perfect judge of someone else's mindset. But I think that the markets themselves are acting, they're responding, exactly as you would expect them to. Like, except under the most extreme circumstances with things like, trading being halted or a power outage or something like that, the markets are responding exactly as they should. The actual decision making that's going on in human minds is, I think, when it comes down to it, is what most people are actually taking issue with.
But I don't
I,
even think you can
I would,
say I don't even think you could say it's irrational,
Yeah.
because who are we to say, guess what? That person who's at the ask tomorrow, let's say, SMSI, and we all think it's going to $8, and we might be right. It might be $8 in 2 days, but in the meantime, is selling shares at 620. I'm not going to call him a dumbass. I'm not going to call him irrational, because maybe he had a price objective. Maybe he bought at 5, and his plan was to sell at 620, and that's perfectly rational. And
Mhm.
maybe he can make more money with that money at $6.20 at 10 a.m. in the morning tomorrow. He can make more money than you holding it till $8 on Friday. So why does that make him irrational?
Yeah, it doesn't necessarily.
it depends on reasons, and the reasons, as we've discussed before, are dependent upon different goals and things like that. But rationality follows a set of logical rules, and those are objective rules that we generally agree upon. Like, we can't use logic to prove logic. We just go with it because of its ability to give us consistent results, right? So there is a way to determine whether or not any given market participant, or even a market itself, I think, is acting in a rational manner. Um, and I would also note that
But does it matter if it's rational or irrational? It is what it is. I think
that's what I meant by the tautology
right,
of it
but
is
I
what
mean,
it is.
I think the opportunity is in understanding the markets instead of criticizing the markets. Right? Let's aim to understand it and see where everyone's heads at. What are they thinking? How are they? Hey, listen, if 99% of people were, completely stupid, and they were permanently stupid forever, right? That's not going to help your inefficient market thesis and fundamental thesis. You're never going to make money. Let's aim to understand it instead of criticizing it. This is the group of people in the world we can sell our stock to, and this is how they value assets. So if we can understand what's important to them, it can make us better traders and investors.
Well, I would say that criticism, at least criticism worth listening to, is necessarily rooted in understanding. It's just a matter of a different conclusion, because to say that criticism isn't warranted is to make a judgment as to rationality or irrationality of a given person. And I would also note that if you believe that the given price for a particular ticker isn't driven by its profitability or the right to the financial value of a given company, then I believe that demonstrates that there is the ability for the market to be rational, because if there is a significant discrepancy in the objective price, which is derivative of the revenues that the company generates, then that to me would seem like something irrational, at least in the short term. Like, for example, the BP oil spill. There was a lot of irrationality surrounding that because, there was a lot of bad press and it didn't really sit with people well. And I think rightly so that they deserve to be condemned, but it doesn't necessarily change the amount of revenue that they're generating and therefore value.
It could. It could have. There was speculation that it might have, and who knows? Maybe they would have turned out to be right. There's people that only in retrospect, were they irrational. But it's all about speculating in the future. And I would add, when you're talking about, we didn't even get to the topic of the financials, because the market's forward looking, and no company is based on, how much money they made in the past 12 months. It's about how much money they're going to make in the future. So now, when you think of it that way, you can't even have a consistent number that everyone can even possibly agree to. In terms of SMSI, there could be so many questions and assumptions regarding the future earnings power of SMSI. Who are you to say that your model's right? You know how many qualitative judgments are inside these financial models in terms of, relationships staying together, people executing, Sprint executing, T-Mobile, SMSI executing. The competition doesn't come in from, some sort of, killer feature on an iPhone, which they make family safety their number one priority, and it's all over the screen as soon as you log in, and everyone cancels their things at T-Mobile. You never know. There's so many qualitative speculations you're making in your financial model, right? So because of that, you can have so many different, price targets and so many different fair values based on all the different people's opinions out there.
You're right, and you absolutely can, but it tends to follow in a general direction. For example, if there were somebody that told me that Smith Micro was going to go bankrupt tomorrow, I would say they're crazy, and I would call them irrational, and I would not believe them. And as far as your point goes, that who am I to say that someone else's model is wrong? Well, I'm the guy with the money. Ultimately, I have to make the decision about whether or not to invest my money. And if I were to believe that, someone else's opinion would be just as valid as mine, then I might as well give my money to, somebody else to manage. But the problem is I don't trust them to make the same assessments that I would, and I believe my own assessments more than somebody else's. And the reason why I believe that isn't necessarily because I think I'm better. It's because that my way has generated consistent results over time. And so I don't see the sense in disputing what I perceive to be a consistent result over time, and intend to continue. And I think you can do the same thing with irrationality. You can get lucky, for example, but yeah, that's all we can go by, is by our experience and whether or not we get consistent positive results.
I agree that performance really is the best way to measure this, and you can look at the fundamentalists. You can look at the people who subscribe to the old value investing way of doing things. And over the past 11 years, every single year, the value funds managed by these people have done worse than the index. They've done worse than picking stocks at random. That way just doesn't do well, and there's a clear explanation for why, and that is that value investing recommends that you don't invest in technology companies because technology is perceived to be too expensive or too speculative. So because tech has been the best performing sector of the past decade, these people missed out on that. They were investing in low PE but ultimately failing business models like Sears or whatever. And that's what they were in instead of Amazon. And so the old way of looking at it, of trying to see, oh, I can figure out how much this stock is worth by adding up these numbers, that's not just producing it's not just producing inadequate results, it's producing dramatically inadequate results.
And you see that playing out right now with GoPro, right?
Mm-hmm.
So GoPro had amazing earnings on Friday, and there's a gentleman in a room who used to be a fund manager, and is like, back in the day, this is the kind of stock that we'd just buy hand over fist. We'd be busy buying tens of millions of dollars worth of the stock in the open market on Friday, but that's not happening now. The free cash flow is insane. The PE is super low, right? So, brings an interesting topic to discussion about the role of retail and sentiment. That's someone who would say, hey, the market's inefficient, right? GoPro should be $17 at least right now based on its financial, on its financials. I would argue that now over 30% of trading volume is retail, and it's only growing. I would make a case that retail investors are better than professional fund managers in imagining what a future world would look like, right? In investing in companies that are going to change the world, right? They're more aspirational. They're more, they don't care about what are the earnings this quarter or next quarter. They want to invest in the future. And I think maybe the professional Wall Street fund managers are so steeped into financials, kind of almost to their detriment. And I have to question whether their model and their approach has permanently been disrupted.
Well, you got to think too. Like these hedge fund managers, they don't buy and hold. Their holding period tends to be in the time frame of months. They're trying to they're under pressure by the people who are invested with them to make them money fast, which was Warren Buffett's problem and why he dissolved the partnerships, because people would either take out their money because they were fearful or he wasn't generating enough profit or whatever. So these hedge fund managers are pressured by the people who are supplying them with the funds to overperform. And then whenever they are done with the stock and it's lost its momentum, or they think it's lost its momentum or whatever, they start to exit the position, which makes the price go down, and then retail tends to follow, and it becomes a self-fulfilling prophecy. But it doesn't necessarily mean anything other than the hedge fund manager's clients wanted him to get out of it because it wasn't making them enough money fast.
Yeah, there may be some of that there, but I'm going back to that question of fair value and fundamentals and financial value versus the influence of speculative value and how that impacts market pricing, right? I'm trying to focus on that, and when you said like Sears underperformed for how many years because they weren't invested in Amazon, right? GoPro, right? Retail's not interested in the stock at all, but the professional fund managers are. Actually, if you look up GoPro, there's like no one ever talks about it on social media anymore. And if you mention it, you'll get attacked by like 100 people saying what garbage the company is, right? But then if you go look, there's like 20 different articles by professional analysts over like the last 6 months about how awesome GoPro is and how cheap it is, right? So they're thinking the market's inefficient because it's not trading at its financial value. But if it's going to be perpetually undervalued, because who can he sell it to? Who can he sell the stock to? Other human beings. And if other human beings are saying, I think a company shouldn't be worth purely on its cash flow over the next 5 years, I think a company should be valued based on its aspirational goals. Are they going to be a disruptor? Are they going to change the world 5 to 10 years from now? If that's how companies are being valued, well, who are we to say they're wrong? Why is that inefficient?
Because we can tell the owners that we want them to start paying dividends, and then the market will see the value in it because it's closer in line to what a security is actually meant to be, which is a partial ownership in the profit. So my line of thinking is that unlike selling a house, right, which you get at one definitive point, in the market, instead of selling the business, the value of the business is influxed by the opinions of the market, which whenever it's set to be acquired by another company, the market's opinion is irrelevant because they tell you how much they're going to buy it for, and then the market corrects to the objective standard, which is how much it's actually going to be bought out for. So the market is really an intermediary commentary on what they think it's worth, but there is a real value in what the business generates and what it can be actually acquired for. And honestly, I think that whether or not a business is acquired is probably a really good indication of what the of how inefficient the market is. because
Now,
because
companies can be acquired for discounts or premiums, right?
that they can, but the market will reflect that. And if the market was truly efficient, it wouldn't be taking the lead from somebody who's acquiring the company for a given financial value.
Jared, are you following? Has James convinced you? Is the market inefficient?
I don't think that the market is inefficient. No, I think that if you look at a company like GoPro, if an institution says, oh, this should be trading higher, the market is inefficient, it's undervalued. I don't know what they really mean in their heart, but I think they're kind of expressing a frustration of like, hey, I did all this research, I found this really cool company, it had all this good news, but the stock didn't go up as much as I wanted. And
And
rather than admit that, they were the ones that made a mistake because they didn't take into account the sentiment, they didn't take into account the catalysts, they didn't take into account these other factors. Instead, they blame everyone else. They say, oh, other people were stupid. Other people, made a mistake. The market is inefficient. The market is irrational, as a way of excusing their own mistakes. That's what they're doing.
oh my God, Jared, you just I love you, man. That's amazing. You took it to another level.
Thank you.
Unbelievable.
Yeah, well, I don't want to gloss over my point because I think it's important. I guess I'll try and simplify it. Would you agree that the market reflecting a buyout price per share of a given company, would you agree with that insofar that the market is taking the lead from an outside source that is relying exclusively on a financial value assessment?
No, I'm actually in one of those investments right now. So, like, I'm in this company XLNX, right? That is Zilix, which is going to merge with AMD. Everyone's heard of AMD, right?
Yeah.
Okay.
Xilinx, I think it is. Yeah.
So here is something that happened. This is just so fascinating to me, right? So 2 days ago, AMD announces, oh, we got this contract with Facebook to build the metaverse, computers, and AMD goes up 10%. Okay. Now, in theory, because Zilix is getting exactly 1.72 shares of AMD, Zilix should have also gone up 10%. But it didn't do that. It only went up 4%. Then AMD gave all of those gains back today. It fell 8%, but Zilix also fell 4%. In other words, even though the value of a Zilix share relative to the buyout price should have been going up and down at the exact same rate as it did with AMD, it didn't. Why did that happen? It's because the people who were buying AMD were buying it based on a different perspective other than the merger arbitrage situation.
Well, I would. Are you looking at that from the value should have increased from the buyer's perspective, or which is to say that people invested in the buyer, their share should have increased?
No, what I'm doing is you said when there's a buyout, the market is taking its cue from this number, and I just gave an example in which that's not happening.
No, let me give maybe a more relevant example. Back in 1998, maybe I'm aging myself here. I'm not sure, but I was trading, back in the dot-com days, in the dot-com boom days. And there were a number of buyouts then that, the buyouts happened not based on financial modeling values. They all happened based on market values, right? There were like GeoCities, there were like all these internet companies that were making no revenue and nothing ever happened, and they were bought for billions of dollars. Why were they bought for? And so retail may have pumped up the stocks or whatever because they were excited about the internet, but then the professionals and Wall Street insiders and everyone, they paid that dollar, they paid that amount, or some get a premium on top of that for that asset because the market said it's worth this much and had nothing to do with financial modeling.
I agree, which to me describes inefficiency.
How's it inefficient? It was bought out. I thought you were trying to say that the buyout is the ultimate thing that proves inefficiency because when it's bought out, it'll be bought out at its financial price. But I'm telling you, when it's bought out, it's not bought out at its financial value. It's bought out at its market value. So companies can be bought for a discount or a premium based on the market value. You're not going to get, if there's a company that's trading, at an 80% discount to its fundamental value in the stock market, they will never get a buyout offer for its fundamental value. That company will have to earn, the demand of the street, the stock demand of the street, to bid up the stock to a certain level. Buyouts are usually not more than 20 to 30% over market value, no matter what the DCF valuation says. And that shows you how important market value is.
Well, let me ask this, because you mentioned the dot-com bubble, and I think something like that can actually be illuminating here. Would you have described the market as efficient when Yahoo's valuation would have put their earnings as more than the U.S. GDP?
Well, at that time, and maybe, like Tesla now, but I don't remember exactly the numbers, so maybe you're right, I don't know. But at any given point in time, right, an asset or an equity is priced at a certain level based on, again, the net opinion of all market participants, which includes speculation about how large can this company be in the future. And in any given moment in time, right, based on macroeconomic factors and based on speculation, hype, whatever you want to call it, a consensus forms from who? From the world of possible buyers of a stock. From these is who you're going to sell your stock to. A consensus forms among all, the entire universe of possible buyers that this stock should be worth 50 times more than what the financial model says it should be worth. But there's a reason for that. The reason is they're speculating about the future. Now, I'm not saying there's no cases. I do believe short squeezes are inefficient, by the way, because in a short squeeze, you are doing something, you're being forced to do something that you don't want to do. So I think a short squeeze is an example of a market inefficiency, by the way. I think
doesn't that kind of conflict with what you said prior, though, that the market is always right? Because if you're willing to concede on that, then really the main difference that we have, which I think you'd be okay in conceding and maybe altering your phrasing a little bit, but really the only difference we have then is time frames, which, if I'm correct, and you can correct me if I'm wrong, you believe that any inefficiencies that may exist are very short-lived, whereas I believe that they can exist on a longer time frame.
Yeah, I think inefficiencies, I think you can have all extended hours periods are inefficient because not all people can participate. So to me, by definition, that's inefficient. I think short squeezes are inefficient because people are being forced to do something they wouldn't otherwise want to do. But that doesn't last very long. I think if you pull up a stock, a daily stock, and look at it over a period of weeks or months or years, that's reflecting the efficient market price. If you pull up something like a 3-day chart and look at it minute by minute, yeah, there could be inefficiencies in there because of short squeezes or halts or, all kinds of crazy things that may happen minute by minute. So yeah, I do believe there are times of inefficiency, but I'm just talking about like the general range of where an equity is priced. Like when people say, oh, Tesla's overvalued, they're not talking about 2 days when it was overvalued. They're talking about, for the last 5 years, it's been overvalued. That's inefficient. Or SMSI is undervalued for the last 5 years. That's inefficient. Like that's what I'm talking about. Not the intraday price actions or, temporary inefficiencies that only last, hours or max a couple days.
Right. So what I've gathered is that and this is pretty much the golden rule in actually selling a given product, is that it's worth whatever you can sell it for. But just because I sell it for one price doesn't mean I couldn't have sold it for more. So, for example, if I were to sell, or rather, if I were to sell, lemonade during the winter, the actual value of that lemonade may not, in my opinion, isn't reflective of that point in time. It would be inefficient to sell it during the winter. The real value of it comes from when it would be most profitable, which would be in the summer. Perhaps that's not the best analogy, but you did bring up something that I thought was interesting. So you said the after hours market is inefficient because it doesn't allow for or doesn't have maximum amount of market participants, correct?
Not that it doesn't have maximum, but there are people who would like to participate who couldn't, because not everyone has those permissions or whatnot with their brokers.
Right. So the people, it isn't efficient because it's not open. So I'm kind of curious. Do you think that non-market participants have a role to play in the market, and whether or not it's efficient?
Non-market participants, give me an example. Not sure I understand.
Okay. So for example, if people are bullish on stocks or the broad market, right? Actual investors, and you can see it on the chart, and it's been trending upwards for a while. Well, today, a lot of non-market participants feel that the economy is headed in a bad direction, which can affect the way that they spend, which in turn would ultimately affect the market, which would make it more skittish. So, to me, it seems like market efficiency is a self-fulfilling prophecy. And if the general public feels that the economy is headed in a bad direction, they start saving, they don't spend as much money on products, that in turn would make revenues go down, and non-market participants would actually have a role to play in efficient markets. But to me, it would just be, because it's based on a general feeling, it would just be a self-fulfilling prophecy.
Non-market participants being customers of the company.
Non-market participants just being an average Joe in average city America. Me, you, any given person, because everybody can have an opinion on the economy. You don't need a brokerage account for that. And how they feel about the economy will affect how they spend.
Yeah, well, I mean, sorry, Jared, go ahead.
If that's the case, then why has the economy been so good, like over the past 2 years? Like, you had an extremely skittish public that was engaged in just the behavior that you just mentioned. Savings rates have like never been higher in American history over the past 2 years. And people, when poll after poll after poll said that they were nervous about the state of the economy and they think it's going in a bad direction. Meanwhile, the actual economic data is pretty good, and we've had one of the best bull markets in history. So it's like that exact premise that you just proposed has played out right before our eyes recently, and it didn't turn into a self-fulfilling prophecy.
Disagree strongly. The economy and the stock market are two totally separate entities.
But both have done well.
I would disagree that the economy has done well. I mean, we pointed out 35% of all U.S. currency ever printed last year. And that kind of generation of money without any actual value created creates inflation. And the stock markets, if people's sentiment towards the market is good, the stock market can do well while the economy is bad. And then that would be classified as being efficient because it's whatever the market decides to price itself as.
Yeah, I'm looking at how much can you sell your stock for, right? So it's really the market participants who are deciding what the bid and the ask is. And like I said, you can only sell an asset for how much someone else is willing to pay for it. So when I talk about market efficiency, that's to me, that's all that matters.
Okay, then we'll stay focused on that then. Would you say that the market would be more efficient with more participants, or or
not necessarily. I gave the example before of very thinly traded microcap stocks, which can, reflate very quickly or have very huge gaps on almost no volume at all. Why? Because the shareholders, like I said this before, I mean, worth repeating, but 100% of the shares outstanding are owned by shareholders who probably know something about the company. So, when you talk about, again, some stock is unknown, therefore it's cheap. Well, everyone who owns the stock knows about the stock. So they could easily raise their ask, and they're the ones who know the information first anyway. They're closest to the company. They're looking at the press releases. They know what's going on. So even if there was only 1,000 shares of demand, if all of the shareholders, thought the company was worth much more, they would put their asks much higher, and that guy with only 1,000 share demand can drive up the stock 80%. It's an exaggeration, but I've seen similar things like that happen with very thinly traded microcaps.
And
Right. So
you also have big
Sure.
inefficiencies even in widely traded stocks. So you look at Moderna, I think it's a really good example. There was a huge run up in Moderna share price in August because of the speculation that we were going to have boosters. Then the news came out that Moderna boosters were in fact going to happen and they got approved. What happened within the next 2 days? Moderna share prices just collapsed. And I think, I don't, you can call that whatever you want it to, but I would say that the fact that company was widely traded, it didn't necessarily make that price action more efficient.
Well, I would say this, because what I'm having difficulty understanding is there is acknowledgement that the market can be at times inefficient for a brief period. I'm not understanding why that period cannot be of a substantial time frame. And I know that substantial here is a nebulous term, but I'm using it to refer to more than a week or two.
You can think whatever you want about the market. The question isn't what's true about the market. The question is what mindset is going to be the most helpful for you if you're trying to make forward-looking predictions. So if you start with the assumption that the market has to be one specific way, and if it's not, then it's just inefficient or irrational and you have to ignore it, that's probably not going to help you find good stocks. If you start with the assumption that yes, price action does make sense, yes, the market is efficient, and if the market is moving in a way that you didn't expect, what that might mean is that your analysis is flawed, there's additional factors you didn't need to take into account. Maybe you should try to expand your understanding and improve your strategy for next time. That's what's going to help you more.
See, and that's what I don't get. If I as an individual can be wrong about a given company in the direction it's headed, I think that I could also be right and everybody else be wrong. I mean, we've had instances in history where that's happened before, even without something as nebulous as stocks. For example, insider buying. Those people would be correct and the market would be wrong because they know something the market doesn't. So the entirety of the market would have to be inefficient compared to the individual and their knowledge. And I would say that it doesn't take insider selling or an extraordinary scenario like that.
I mean, you can be right, and then the rest of the market can catch up to you in a sense. But what I would say is that you had a room for improvement in the sense that if you bought a stock and then it goes down and then eventually it goes way up and you make a bunch of money, I would say something like you could have improved your timing, you could have improved your entry, and maybe you slightly misread the sentiment and that's why you got your timing wrong. And by having a better way of looking at sentiment next time, that'll help you time better entries. That's what I would say.
Right. Well, and for me, for me personally, I'm not really even concerned about timing. I'm just concerned about whether or not a price is reasonable. So for me, the goal isn't to make as much money as I can. It's to be able to retire by, X years old, to be a millionaire by X years old. And I don't necessarily mind if my entry or exit or additions are not ideal. I just care about my own personal goal and whether or not I'm on par with that. So, and that's why I think that, because if that's my goal, that may be very different from the general market's goal, which is to make as much money as in as short a time frame as they can. And I would think that because they don't really contribute, to my life or a meaningful part of it, that's what makes me right over them, is because, you know, I have to be the one to set the goals for my life. And therefore that price is right for me, even if it may not be for the rest of the market.
Yeah, and it's a good time to say that I don't think there's any wrong way to invest or trade.
I agree.
And right, so everyone has to come up with a system that's good for them. And by the way, I respect very much the fundamental process, and people who trade just based on valuation. I think it can work. I think it works for a lot of people. But by the way, it could also fail miserably for a lot of people because it also requires a whole bunch of qualitative analysis and market research and wisdom and experience, to be able to speculate in the future, is this company going to grow earnings? I used to be in the early days a fundamental investor purely, right? Just looking at PEs and things like that when I didn't have the knowledge or experience to understand how important management was, when I didn't understand the subtleties of what it takes to execute in a business, the subtleties of what's being said on a conference call. I mean, it is extremely hard to invest if you're just basing on numbers alone. Most people fail miserably at it, honestly. I think in our community at Story Trading, and the contributions we get from Mark Gomes, the reason more than anything that he's successful in quote unquote fundamental investing is because what he's really doing is investigative research and market research, and getting in touch with people close to the company and talking to management and making really good qualitative predictions about how the company will do in the future. And I would argue that has almost nothing to do with the spreadsheet. So, that's the success that a lot of people are having in our community, is from that sort of process, that sort of collaborative research and investigative journalism is really what's driving the success of our quote unquote, fundamental approach to investing. So there's no wrong way to do it. Part of my philosophy is that everyone's right and everyone's opinion counts. And I want to hear everyone's perspective. I think that makes me a better investor. It enables me to understand the story behind the trade, right? And next week we're going to talk about the implication of this, right? The implication of believing that the market is efficient. The implication of that is now you can go out and be, again, inspired or motivated to learn about the history of the stock. What caused it to go up? What caused it to go down? What are the concerns of the investment community? What gets them optimistic about the future? What gets them pessimistic about the future? You could only go about doing that exercise if you believe the market's efficient. So fundamental investing, yeah, it could work, but I think what Story Trading has to offer, I think, can work much, much, much better. And that's the start of it, right? The start of it is looking at the chart, and then we'll get into the 4 pillars and everything, and how we look at stocks holistically after that, to be able to make better informed trade decisions.
Right, and I may not agree with everything that you say, just as much as you may not agree with everything that I say. I think that what makes a person a successful investor is being eclectic in learning and taking a bit from everybody, because I don't think that there's any two identical traders, investors. Even if you have a direct apprenticeship with someone, you're going to form your own ideas.
Yeah,
So
I
what I think
completely
is
agree.
most important is for somebody to have a thorough understanding in what they believe, which is why we're having this conversation here, and to be able to have a good performance history from it, and to be able to execute. Because for me, it's all about niche. I am quite sure that I could have been, and still can be, a different kind of investor. But right now, this is what works for me, and I will continue to learn from other people and their perspectives. And who knows, maybe adopt a new approach or change my strategies.
Yeah, I was gonna say I wouldn't even agree with myself like 12 months ago. I feel like I've changed so much
Right.
since I started doing this.
Yep. Yep. So lifelong learning, and there's no right or wrong. You got to come up with a system that works for yourself.
Yeah. Just don't YOLO on options with
That
your net worth. That's the wrong way to do it.
that is the wrong way to do it. Although I would say, man, there was in one of the chats I was in this morning, there was someone on Reddit who YOLO'd like $7 million, his entire account, into one stock, right? And presumably it's someone that probably started with close to nothing and is part of the Reddit thing and made a lot of money. Yeah, and a bunch of my colleagues are saying how stupid this person is and how crazy it is, and I'm like, you know what though? That's the time to do it. When you're young, you'll YOLO that, because you're gonna learn from that, and there's nothing that replaces experience. I mean, that the best thing that can happen to you is going through all sorts of different experiences, and that's the time to do stupid things. So I'm not going to judge the person, and I've been there, done that. I've been in his shoes, so I'm not going to judge that. I took extraordinary risk when I was younger, and it was important for me to go through that. So I'm not going to judge anybody else.
I do, but only because it's fun. But yeah, no. I really enjoyed the conversation. I'm gonna have to hop off here though because I got
Yep.
dinner
Yeah,
ready.
we're
Unfortunately,
almost 7 minutes overtime anyway. So guys, tune in next week. We're gonna do this every Wednesday, 8 p.m. So it's gonna be awesome philosophical conversations. Put it in your schedule. We're gonna do Sunday, 8 p.m. For those of you who are not VIP members, and even if you are, we'll do a wrap up and go through everything that we did in the VIP community in the past week. Sunday, 8 p.m. and again Monday, 4 p.m. Trade of the week. So hope to see you on a regular basis, everyone.
thanks for having us.
And thank you, James, for your participation. Thank you, Jared.
You're welcome. It was great to be here.